Imagine waking up one morning, checking your phone, and seeing that your money has quietly grown while you slept. No stress, no confusing charts, no frantic trading. Just steady, calm growth. That simple picture is exactly why millions of people invest in ETFs, and why today you're about to learn how to do it too. Before we dive in, think for a moment. What if you finally understood investing in a way that felt clear, easy, and maybe even exciting? Stick with this story till the end, because by the time we're done, you'll not only understand ETFs, you'll be able to start investing with confidence, even if you've never invested a single dollar before. Let's start with something simple. Imagine a big basket. Inside this basket are hundreds of different fruits. Apples, oranges, bananas, mangoes. Now imagine you could buy that entire basket for one single price. That's what an ETF is. Instead of buying individual companies, like picking one apple or one orange, you buy a basket filled with lots of companies at once. That basket is called an exchange-traded fund. Why does this matter? Because buying a basket instead of one fruit protects you when one piece goes bad. If a single company performs poorly, it won't drag your whole investment down. The other fruits balance it out. This is one of the biggest reasons beginners love ETFs. They spread your risk without you having to do anything complicated. Now here's something even better. ETFs are easy to buy, just like a normal stock. You can buy them on any trading app. You don't need huge money. You don't need to be a financial expert. You just need patience and a plan. But let's move into something more real. What actually happens when you invest in an ETF? Imagine you invest in an ETF called an S&P 500 ETF. This is one of the most popular types in the world. It includes the 500 biggest companies in the United States. That means when you buy this single ETF, you're actually buying tiny pieces of Apple, Microsoft, Amazon, Google, Tesla, McDonald's, Coca-Cola, and hundreds of others. If one company struggles, the rest support the total value. If many companies grow, your ETF grows too. Here's a real example. If someone invested $1,000 into an S&P 500 ETF 10 years ago, historically that money could have grown to around $3,200 today, without them needing to pick stocks, without needing to check the market daily, and without needing to predict anything. That's the quiet, steady magic behind ETFs. But here's where beginners often get stuck. They think, okay, but which ETF should I buy? Or, how do I know what's right for me? And that's where you're about to become smarter than 90% of new investors. Every ETF has a purpose. Some are designed for growth. Some are designed for stability. Some focus on technology. Some focus on energy. Some focus on the entire world. Think of ETFs like playlists. You choose the playlist based on your mood. In investing, you choose your ETF based on your goals. Ask yourself a question. Why do you want to invest? Is it for long-term wealth? Is it to beat inflation? Is it to retire early? Is it to create passive income? Think about your answer and drop it in the comments section. I'm curious what your personal reason is. Now let's look at 3 popular types of ETFs beginners usually start with. The first one is broad market ETFs. These follow entire markets. They are simple, reliable, and easy to understand. A great example is that S&P 500 ETF. The second type is sector ETFs. These focus on specific industries like technology, healthcare, energy, or real estate. For example, a tech ETF might include companies like Nvidia, Apple, and Meta. The third type is bond ETFs. These don't grow as fast as stocks but are usually more stable. People often use them to protect part of their money. The beautiful thing is this. You don't need to choose only one. Many investors build a simple mix, something like 80% in a broad market ETF and 20% in a bond ETF, or 70% broad market, 20% tech, 10% emerging markets. Simple structures that balance growth with stability. Now here comes a moment every investor must understand. ETFs are long-term tools, They are not designed to make you rich overnight. They grow slowly and steadily, like a tree. And just like a tree, they grow bigger the longer you leave them alone. Let me tell you a quick story. Imagine two people, Alex and Jordan. Alex invests $100 every month into a simple ETF. Jordan waits, unsure, thinking, maybe next year. 10 years pass. Alex has a growing portfolio worth far more than they invested. Jordan is just starting, wishing they had begun earlier. The difference between these two people wasn't money or skill. It was the decision to start. Which one do you want to be? Leave your answer in the comments. Now, let's talk about something that scares beginners: the risk. Yes, ETFs can go down, markets can fall, your value can temporarily drop. But history shows something powerful. Markets fall for a while, but they rise for a long time. Every major downturn, recessions, crashes, pandemics, crises, eventually recovered, usually to even higher levels. And people who stayed invested often made the most money. So here's a powerful mindset to remember. Dips are normal. Patience is profit. Another question beginners ask is, how much should I invest? The truth is, start with whatever you can. Even $20 or $50 a month can grow into something meaningful over time. What matters most isn't the size of your investment. It's the consistency. Small steps repeated every month turn into big results. Let's walk through a simple example of making your first ETF investment. Imagine you open your investing app. You type in a popular broad market ETF. You check the expense ratio, the fee the ETF charges, which is normally very low. Then you buy one share. That's it. You're officially an investor. No need to memorize complicated strategies. No need to track 100 different companies. Your ETF handles everything behind the scenes. At this point, if this guide has helped you understand ETFs more clearly than before, go ahead and like this video, subscribe, and share it with someone who needs this knowledge. It encourages us to make more content like this. Let's move deeper with one more real example. Suppose you invest $200 every month into a simple ETF that historically returns around 7% yearly. In 10 years, that becomes around $34,000. In 20 years, it becomes around $104,000. In 30 years, it becomes around $245,000. That's the power of time. The earlier you start, the easier your future becomes. Now let me ask you something meaningful. If money wasn't a problem, what would you do with your time? Travel the world? Take care of your family? Pursue your dream career? Think about it, and drop your answer in the comments. You never know who you might inspire. As we reach the end of this documentary, remember this. Investing in ETFs is not about getting rich fast. It's about building a life where your money works for you, quietly, consistently, day after day. Most people never start, but you can be different. You can be the person who takes small steps now that lead to a powerful future. If you learned something new today or feel more prepared to start investing, make sure to like, subscribe, and share this video. Your support helps us create more content to guide you on your financial journey. And before you go, here's one last question to think about. What is the very first ETF you're planning to start with? Leave your answer in the comment section. I'll be reading them.